You've probably seen a big corporate announcement before and felt like you needed a special decoder ring just to understand it, right? Well, today we're going to fix that. We're taking a real announcement from DCB Bank and breaking it down step by step so you can see exactly how to read a company's report card. So this is it, the actual document. And yeah, I know, it looks a little intense, but stick with me, because buried inside all that corporate speak is the real story. It tells you how a company's doing, and even more importantly, what its plans are for the future. So what did DCB Bank actually have to say? The whole thing really boils down to three key things. First, their grades for the year, the financial results. Second, a little something for the people who own the company. And third, a huge plan to raise money for the future. We're going to unpack each one, and we'll start with the numbers. Okay, first things first. Let's dig into the financial report. This is really the heart of it all. We're going to follow the money and see just how well the bank did over the past year. It's the million-dollar question, isn't it? After a full year of business, did they knock it out of the park, or was it just meh? Let's find out. And boom, there's the headline number, a net profit of 273.1 crore rupees. Now, that's the bottom line, what's left after all the bills are paid. But a big number by itself doesn't mean much. The real question is that actually any good? And this is why context is everything. Check out this chart. Last year, they brought in about 245 crores. This year, that number jumped up to 273. That upward trend is exactly what you want to see. It's the first big green checkmark on their report card. So we know they're making more money, which is great. But how are they doing it? Understanding where a bank's revenue comes from tells us a ton about its strategy. And luckily, the report gives us a peek under the hood. And this chart just lays it all out. A massive 71% of their business comes from retail banking. That's from regular folks like you and me with our savings accounts and car loans. So the big takeaway here is pretty clear. DCB Bank is, first and foremost, a bank for everyday people. So the bank had a really solid year, thanks mostly to its retail customers. But what about the owners of the bank, the shareholders? Do they get a piece of the pie? Well, that brings us right to the second major announcement. This is always a huge deal. When a company makes a good profit, what do they do with it? Do they keep it all to reinvest, or do they share the wealth? Well, in this case, it was very good news for the investors. And there it is, straight from the horse's mouth. The board is recommending a dividend of 1 rupee and 45 pies for every single share. It's basically a cash payout, a direct thank you to the owners of the company. And just in case that term is new to you, that's all a dividend is. It's the company taking some of its profits and handing it back to its shareholders. Think of it as a bonus for being an owner and believing in the business. But a dividend is way more than just money. It's a signal. It's the leadership team saying, hey, things are going so well, and we're so confident about the future, we don't need to hang on to every single rupee. It's a massive statement of strength. Okay, so a profitable year? Check. Rewarded its owners? Check. But the story doesn't stop there, not even close. This third part of the announcement is all about what's next, and it involves raising some serious cash. Get this, the board greenlighted a plan to raise up to 2,000 crore rupees. They're planning to do it in two main ways. First, by borrowing money through bonds. And second, by selling new shares of the bank directly to big investment firms. Now, the official terms are a bit jargoning, so let's quickly demystify them. First up are these things called Tier 2 bonds. The easiest way to think about them is as an extra safety cushion. Regulators require banks to keep a certain amount of cash set aside for emergencies, and these bonds are just a way to beef up that financial foundation and make the bank even safer. The other method is a QIP. This is pretty smart. Instead of selling new shares to everybody on the open market, they do a private sale of a huge block of shares directly to a few big qualified investors. It's a much faster and more efficient way to raise a lot of money. So why raise all this money? For a bank, the answer is simple: growth. You see, capital is the fuel for a bank's engine. All this new money is what they'll use to give out more loans, open new branches, and basically just hit the accelerator on their expansion plans. All right, so we've looked at the profits, the dividend for shareholders, and the big plan for growth. Now let's zoom out and put all these pieces together. What's the big picture here? When you line it all up, a really clear story emerges. It's almost like a three-act play.
Act 1, the bank showed it had a great year with solid growing profits. Act 2, it rewarded its owners for that success. And for the finale, Act 3, it laid out a bold plan to get even bigger.
And that, right there, is the key. Any one of these things would be interesting on its own, but seeing all three together, strong results, happy shareholders, and a massive plan to raise cash, tells a complete story. It's the story of a bank that isn't just winning today, it's actively fueling up for tomorrow.
And so, this whole announcement leaves us with one big, forward-looking question. When a profitable bank decides to inject this much fresh capital into its engine, it's not just planning for another good year. It's signaling some serious ambition. This report card isn't just about the past. It's a statement of intent for the future. The only question now is, what are they going to do with all that fuel?